So with all this talk about how easy they are to get and how fast you can get the money, it's really important to make sure we're all on the same page here.
Yeah, we want to make sure everyone understands what they're getting into.
The Ultimate Guide to Small Business Merchant Cash Advance, they emphasize that this is serious stuff.
It is, yeah.
These financial products, they can really impact your business, for better or worse.
Oh, for sure.
And the thing is, even though MCAs can seem like a quick fix, they often end up costing you way more than a traditional loan would.
Much more, yeah.
So it's not just about how fast you can get the money.
No, it's not just about speed.
It's about really thinking through the long-term costs.
Right, you got to weigh the benefits against the costs.
Right, exactly. Can those benefits outweigh the higher cost?
Yeah, and will this affect my business's financial stability in the long run? Those are the questions you got to ask yourself.
Right, so it's all about really understanding MCAs before you jump in.
Totally. Be informed, make a decision that's going to help your business in the long haul, not just in the short term.
Makes sense.
Yeah.
Okay, so let's break down the nuts and bolts of how MCAs actually work.
Sure. So remember, it all starts with a company offering you a chunk of cash up front.
Okay.
And they're basically buying a piece of your future sales. They figure out how much to give you by looking at your daily credit card transactions or just your overall revenue patterns.
Okay.
So once you agree on the amount, there's this thing called a holdback rate.
A holdback rate, yeah.
It's a percentage, usually somewhere between 10 and 20%, that they take out of your daily credit card sales.
Okay.
And this keeps going until you've paid back the full amount.
Got it.
And the total amount you have to pay back, that's determined by that factor rate we talked about.
Right, the multiplier.
Exactly. So say your MCA has a factor rate of 1.3.
Okay.
That means no matter how long it takes, you're going to end up paying back 1.3 times the original amount you got.
Even if it takes a while, because sales are slow.
Even then.
Got it.
Yeah.
And then there's the repayment period, right?
Right.
How long do you have to pay it all back?
Well, the good thing is it's pretty flexible. It really depends on how much your business is selling.
Okay.
If you're doing great, you'll pay it back quicker. If sales are slower, it takes longer.
Makes sense.
Usually it falls somewhere between 3 and 18 months.
Okay, 3 to 18 months. So let's talk about the difference between MCAs and traditional loans.
Right, because they are very different animals.
They really are.
Mhm.
So first off, just the basic structure. A loan, you borrow a specific amount of money, right?
Right.
And then you pay interest on that borrowed amount.
Yeah, interest on the principal.
MCAs, they're not about borrowing.
No, it's like selling a part of your future sales, remember?
Right, right. And repayment, that's different too. Loans, you got those fixed monthly payments.
Right. Same amount every month.
MCAs, it changes every day depending on your credit card sale.
Exactly. Up and down with your sale.
And getting approved, that's a whole different story.
Oh, yeah.
Loans, banks want to see your credit history, all that stuff.
And they want collateral too, usually.
Right, like your house or your car.
Mhm.
MCAs, they're more focused on your cash flow, what your sales are looking like right now.
Right, and past sales too.
So they're more accessible to a wider range of businesses.
They are, especially those that might not have perfect credit or a ton of assets to put up.
But then there's the cost. Loans, that's where interest rates come in.
Right, the APR.
MCAs, it's all about the factor rate.
And that can get expensive, especially if you convert that factor rate into an equivalent APR.
Right. It can be much higher than the interest you'd pay on a loan.
It can, for sure.
And repayment terms are different too.
Yeah.
Loans can stretch out for years.
They can, yeah.
MCAs are shorter, more like those 3 to 18 months we talked about.
And they have that built-in flexibility, remember, adjusting to your sales.
Right, right. And lastly, there's regulation.
Ah, yes, regulation.
Traditional lenders, they're under the microscope. Lots of rules they have to follow.
Lots of oversight, yeah.
MCAs, not so much.
That's one of the big debates around them.
So let's sum up those key differences.
Okay.
MCAs, they give you flexibility in how you repay, and they're easier to get.
Definitely.
But there's a trade-off. You don't have the same level of protection you get with a loan, and it can cost you a lot more.
It's a trade-off, for sure. You got to weigh the pros and cons.
Okay, so let's say you are thinking about getting an MCA.
Right. You've decided to explore that option.
What are the usual terms and conditions you might find in the agreement?
Well, the guide goes through some common things you'll see. First, they'll usually spell out that repayment is based on a percentage of your daily credit card sales.
Right, that holdback rate we talked about.
Exactly. And they'll state the factor rate, which determines how much you'll pay back in total.
Okay.
We've already talked about the typical repayment period, that 4 to 18 months.
Right.
But there are some other things you got to be aware of, like A lot of MCA providers will want you to sign a personal guarantee.
A personal guarantee. What's that?
Basically, it means you're personally on the hook for the money if your business can't pay it back.
Oh, wow.
Yeah, it's a big deal. And then there's this thing called a UCC1 filing.
UCC1. Okay.
It's a legal thing that gives the MCA provider a claim on your business's assets if things go south. It's not exactly like collateral for a loan, but it's similar.
Got it. So if you can't pay, they can go after your business assets.
Yeah, potentially. And then, to make things easier, they'll usually set things up so they can take the money right out of your business bank account.
Automatically.
Automatically, yeah.
How do they do that?
Through ACH, those automatic clearinghouse transfers. It's all electronic, makes it easy for them to collect. And one more thing that's important, the guide mentions that a lot of MCA agreements, they have clauses that stop you from taking out other loans while you're still paying back the MPA.
Oh, really? So you're kind of stuck with them.
In a way, yeah. It's something to think about because it could limit your options if something unexpected comes up or you see a great opportunity.
Right, right. So to recap, the key terms to keep in mind, there's that percentage of daily sales for repayment, the factor rate that determines the total you owe, the shorter repayment terms, personal guarantees, those UCC1 filings, and the potential limits on getting more financing.
Got it.
Now let's switch gears and talk about why you might choose an MCA. What are the good things about them?
Well, the biggest one, and the ultimate guide really hits on this, is speed. You can get that money fast.
That's what everyone says.
It's true. The applications, they're all online, streamlined. They can review it and approve it super fast.
How fast are we talking?
Sometimes you can get a decision in a day or two. And the money, it can be in your account in just a few business days, sometimes even the same day.
Wow, that's amazing.
It is. And that's because they're not digging deep into your credit history like banks do. They're looking at your sales, what's happening right now.
So if you have an emergency or a great opportunity pops up, you don't have to wait weeks or months.
Exactly. You can jump on it. That's a huge advantage for a lot of small businesses.
And another good thing, it seems like you don't need collateral like you do with a loan.
That's right. Most MCAs are unsecured, so you don't have to put up your house or your equipment or anything like that.
So that's a big plus for startups or businesses that don't have a lot of assets, right?
It is, yeah. They're looking at your cash flow, what you're bringing in, but, we talked about those personal guarantees.
Right. That's often how they protect themselves.
Exactly. Instead of taking your house, they might go after you personally if you can't pay.
Okay, so there's still some risk there. And this flexible repayment thing where it's tied to your sales, that sounds pretty appealing.
It is, especially for businesses that have busy seasons and slow seasons.
Right, because with a loan, you're stuck with that same payment every month, whether you're making money or not.
Exactly. But with an MCA, it adjusts. You pay more when you're selling more and less when things are slow. It just makes more sense for a lot of small businesses.
Right, because your income isn't always predictable.
Totally. And then the last big advantage the guide talks about is the approval process. It's usually a lot easier and faster than getting a traditional loan.
Because they're not digging so much into your credit score.
Right. They care more about how much you're selling right now, your daily credit card transactions. So even if your credit isn't perfect or you haven't been in business that long, you still have a chance.
So it opens up options for businesses that might not qualify for a loan.
Exactly. But, there's always a trade-off.
Right, that higher cost.
Exactly. You're getting easier access and flexibility, but you're paying for it.
Okay, so to sum up the good stuff about MCAs, you get the money quickly, you usually don't need collateral, the repayment adjusts to how much you're selling, and it's easier to get approved.
You got it.